Now, economists at the World Bank have raised concerns that the slower growth seen in emerging markets since the tail end of the global financial crisis could be part of a longer-term trend. Now, Korea is no exception, with the economy widely expected to only grow in the 2% range next year. Hwang Ji has the details.
Emerging economies are at a crossroads, facing the risk of a slower growth era. That's according to a report by the World Bank. It says the growth rate in 24 emerging countries, including China, Brazil, and South Korea, dropped to the 3% range this year from 7.6% posted 5 years ago. The United Nations has also slashed next year's growth forecast for developing countries by 0.5 percentage points to 4.3%, while leaving that of advanced nations unchanged at 2.2%. From the early 1980s until the global financial crisis in 2008, emerging countries led global growth and posted record growth figures. But their performance in recent years has weakened due to slowing global demand and plunging commodity prices. Many are concerned that Korea is also part of this protracted slump, especially as the Chinese economy is moving to a slower yet safer and more sustainable growth, focusing on domestic consumption over government investment. Bilateral trade with China accounts for a quarter of Korea's total trade.
Slowing growth in China is not a temporary trend. Coupled with tumbling metal and oil prices, the outlook for Korean exports look pretty dim for the foreseeable future.
Given that major private financial institutions expect the economy to expand in the 2% range in 2016, while the government targets 3.1% growth. To do so, the government has pledged to push through structural reforms to improve the business environment and tackle issues like the nation's rapidly aging population. However, many are skeptical about completing such reforms, with general elections set for next year and the presidential election set to take place the year after. Hwang Ji, Arirang News.